How you doing? My name is Alex Carlucci with Gustin Cho Associates. Breaking news today, the Fed raises rates by 3/4 of a point to 3 to 3 1/4 on the Fed funds rate. That's the overnight rate that they lend to banks. So what that does is it temporarily drove the 10-year note and the 2-year note way higher, and then the stock market crashed. And then the stock market rallied back as rates got better because you're saying things that might mean that they're getting to the end, but it's not really getting to the end. And then he was very clear at the end that they're going to keep the pedal to the metal, and it may be until 2025 that they start reversing the rates. So they're kind of saying they're not going to start lowering rates till 2025, and the market didn't like that. The stock market didn't like that, and then the rates got a little bit better. So right now, it looks like we're going to have higher rates going forward for a while. They're going to keep them there, and they're going to keep raising them. They said they're going to take the Fed funds, which is from 3 to 3 1/4. There's always a 1/4 point range, 3 1/4 to 4.4 by the end of the year. That's December, so it's a few months away. They're going to raise the rates another point and a quarter in just the next 3 or 4 months. So we're going to see higher rates in the mortgages. It's going to hurt the economy. The house prices are probably going to come down. We're going to see a lot of activity slowing down in the housing market. We're going to see the stock market probably going down. We're going to see people buying less at the stores. We're going to see this inflation thing start to slow down, and we're probably going to see supply side of economics start to increase. So we're going to start to see goods sitting on the shelves at stores where they're going to reduce prices. That's going to be deflationary, and that's what they're trying to do. We're going to see house prices fall 10, 20, 30% over the next year, which is deflationary. We're going to see rents come down. The demand's going to be going down because of the higher rates, and the supply is going to build up, and that's going to cause the deflation. So that's how I see it. When house prices come down in the next 6 months, I recommend everybody get in there and buy them, because when this deflation's fixed, they're going to start lowering rates, and we're going to start inflating the market again. But hopefully at a reasonable pace, not this crazy pace we've had over the last 2 years during COVID, but a normal 3, 4, 5% inflation rate, or sorry, housing appreciation amount per year versus 20, 30% per year. The inflation should be at 2%. That's perfect for the Fed, but you're going to see house prices appreciate 3 or 4%. They appreciate a little bit faster than the inflation rate. So that's how I see it going. If you want to wait a few months to buy a house, you can. If you find the house of your dreams, I say buy it. You're always going to be able to refinance it in 6 months to a year when they start lowering rates, maybe more closer to 2025, late 2024. You can refinance and save your money. So if you want to get into a house, don't hold back. But if you really want to try to get a bargain and play the game that everybody else could be playing, waiting, and then chase everybody through that small little door when it starts happening, you can do that. But if you find the house of your dreams, you got a stable job, it's not a bad time to buy. But if you're tight on money and you've been out of the game because rates are too high and prices are too high, then you can wait. But it's going to be madness because there's a lot of pent-up demand out there. When they start lowering rates, there's going to be madness for stocks to go up and the housings to go back up again. So that's my outlook on the future of rates and what the Fed's going to do. If you want to get a mortgage, give me a call. We're licensed in 48 states. My phone number is 630-915-7550. Thank you very much. Please like and subscribe.